What's going on, guys? Welcome back to the channel. Today I wanted to dive into some important changes from the Bank of Canada and what this could mean for all of us, especially when it comes to the housing market and mortgages in Canada. So let's start with the big news. So economists are saying that the Bank of Canada is going to take a more aggressive approach to cutting interest rates. So if you've been following the news, you know that they've already cut rates a couple times recently, right, in the summer. But it looks like they're not stopping there, right? So there's a strong chance that we'll see the overnight rate drop to 4.25% at their next meeting on September 4th, which is coming very soon. And here's the kicker. That might just be the beginning. According to the recent survey of economists by Bloomberg, we could actually see rates drop even further. They're predicting that by next summer, the rate could be as low as 3%, okay? And if inflation continues to ease up, we might see it settle around the 2.75% by 2026. Okay, very interesting news here. Now, why is this happening? Well, it's all about inflation, right? So over the past couple of years, inflation has been the major concern for the Bank of Canada. That's what's forced them to hike rates so aggressively, right, at the beginning of 2022 to keep things under control. But now we're starting to see some relief on that front. And as inflation pressures continue to ease, the bank has more room to shift gears and start lowering rates to support the economy. Now, it's obviously not all good news because if they need to support the economy, that means the economy won't be in a good place. Okay, so what does this mean for the average person? Lower interest rates usually means cheaper borrowing costs. Okay, so if you're looking to buy a home, refinance your mortgage, or even take out a loan for other reasons, these rate cuts could actually make a big difference in what you end up paying, right? So for many Canadians, this is welcome news, especially those who are renewing 2025, 2026 after dealing with these high rates for so long. And it's not just about making borrowing cheaper. The Bank of Canada rate cuts are also part of the broader strategy to manage the economy from the Bank of Canada's perspective. The goal is to slow things down just enough to curb inflation without pushing the economy into a full-blown recession. Now, it's obviously a very delicate balance they have to do here. And the BOC is trying to thread the needle to achieve what obviously we know as a soft landing, okay? Now, I think we should just take a step back, zoom out, and take a look at the bigger picture. So Canada's economy is closely tied to what happens in the US. Our neighbors to the south are also dealing with their own economic challenges. And the Federal Reserve is expected to start lowering interest rates soon as well. So when the US economy slows down, it tends to have a ripple effect here in Canada. It's just the way it is. This could actually help push our rates down even further, which is an interesting point, okay? Giving the Bank of Canada more justification to its rate cutting agenda, right? Now, how will this impact the housing market, right? So you might think with rates coming down, the market could get a big boost and we're going to fly up from here. Now, while lower rates can certainly make mortgages more affordable, which is good, it's not that simple, right? Builder confidence across Canada is still pretty low. And the Canadian Home Builders Association recently reported that sentiment among home builders is pretty gloomy, especially in the single family and multifamily segments. Why? There's a few reasons, okay? First, we're dealing with a lot of red tape when it comes to getting new homes built, right? And that is extending from municipal, provincial governments, I'd say mostly even municipal governments, zoning issues, permit delays, and high development taxes are all making it tough for builders to bring that new supply to market that we need. And even with lower interest rates, these obstacles remain a significant challenge. So if you look at Ontario and British Columbia, the two most expensive provinces, builder confidence is particularly low right now. In the Greater Toronto Area, the market activity has been almost non-existent, which is a big problem if you consider that Ontario has the largest housing deficit in the country. So if we don't see some major changes soon, this could get even worse. Now, what's being done about it? So the federal government came out just yesterday, I believe, and you know, they're trying to save face, and I think mostly it's just trying to get voters back on their side. Don't think it's going to go well though because of so much damage that's been done, but they've obviously tried to launch the initiative to bring more affordable housing to market, right, on federal lands. Okay, so they talked about the 56 properties that they're listing for residential construction, that they're going to do a long-term lease. They've also introduced a housing accelerator fund, multi-billion-dollar program designed to streamline permit and zoning process at the municipal level. Obviously, like, these are positive things, right? When you kind of look at them, very positive things, but let's be honest, it's a very small drop in the bucket. CEO of Canada Home Builder Association pointed out that there's a lot more that needs to happen. This is not enough. We need a comprehensive effort from all levels of government to address the supply shortage. This includes looking at development taxes, finding new ways to fund infrastructure so that the whole thing doesn't fall on new home buyers, which it is right now. And what about the future, right? So if we look ahead, what do we see? With the Bank of Canada likely to continue these rate cuts into next year, borrowing costs should keep coming down, which will ease the pressure, but it's going to take a lot more than those lower interest rates to really turn things around. So we're in a bit of like a wait and see mode right now. And I personally think that with these rate cuts, what will happen is that a lot of sellers will start going to market, right? People will start getting more confident about selling their house, and what will happen is some buyers will step up to the plate and buy them and bid for these properties. Now, I personally think because so many houses are going to hit the market, what this is going to do is it's going to create a flood of new listings and inventory, right? And I think some buyers are going to step up to the plate and bid for them and buy these properties, but I think more inventory will not sell, right? Not all of it will get absorbed by buyers, which will create kind of a sideways downwards market. That's what I personally think will happen over the next year and a half. Just my opinion, I could be very wrong. When I think about the economy, all the things that I read every day, the videos that I make for you guys, I think the market's going to go sideways and down in terms of real estate averages across the country. But then what I think will happen is we're going to get a next leg up at the beginning or around 2026, 2027. That's when the next leg of this real estate bull market will come in. So I think that next year, right, 2025, I think it's going to be a slower year, okay? And I think things are going to sell, but I think not enough things will sell, and people will have to lower their prices, and obviously averages will go down. So prices will kind of sideways down. I don't know if we're going to get a huge major crash. Obviously it could happen. Anything can happen. You got to think that way when it comes to markets such as the housing market. But I do think that we're going to get some kind of like this long drawn out downward sideways market, okay? And I think that's honestly a good thing because the craziest thing was how houses effectively doubled in like a year. Like 2020, 2021 were just nuts. So 2022 is when this all started really correcting. And I think it's just going to continue for another year and a half until we reach 2026, 2027, where the next leg up of the real estate housing market will go up, right? The next bull market, right? And so that's my personal thoughts. And I think all of these policy changes are coming to effect. And they're going to help very small, like it's not going to make a drop in the bucket, but I think people are going to get payment shock. People are going to have to sell because of potential job losses. If we do get some sort of recession, it's going to cause problems for people. They're going to have to sell their house and downsize. I also see a lot of reports talking about baby boomers needing to sell to fund their retirement, to downsize and go into a condo. So if baby boomers start selling their properties, those typical larger priced properties are going to go down in price as well. And so all of this is going to lead to great situation for first-time home buyers, cheaper real estate, which is good, right? It's what we always talk about. If we have cheaper real estate, this is good. Lower interest rates, good. That will lead us to the next leg of the market, okay? And if you can be patient through this period, you will be rewarded, right? Long-term approach, long-term mindset will yield the success of holding assets, right? That's the best way to do it. So I hope you guys enjoyed this video. What do you think will happen over the next year and a half with the market? I'm excited to see what happens, and I will see you guys in the next video.